Good evening. Thank you very much. You're all very welcome to tonight's program. Just thinking about our first Global Economy Series program this year, we had Raghu Rajan and there was a monsoon arranged. So we've arranged for some nice London weather for Martin Wolf tonight. So thanks for coming out through the lashing rain. I'm Niamh King. I'm the Vice President for Programs here at the Council, and it's a delight to see such a huge audience out here tonight, a testament to welcoming Martin Wolf back to our stage. In fact, Martin, the first Global Economy Series we did in March of 2009, Martin was the first speaker ever in this phenomenally successful series. And few people can come within 12 months back to the Council and garner an audience like this. So thank you very much, Martin. He's got a new book out. It's for sale. It's called The Shifts and the Shocks, and it'll be for sale in the back. Of course, we'd like to thank Zurich for their incredibly generous sponsorship of the Global Economy Series. They're who makes this all happen. We have students in the audience and a huge corporate audience. Thank you very much to Zurich. Dick Longworth is here. He'll do a write-up of the program. It'll be available online after about 10 a.m. tomorrow morning. A few upcoming programs that might be of interest to you. Nick Lardy will be here on the 21st of October to talk about the rise of China's private sector. We will have Francis Fukuyama here talking about 25 years since his seminal End of History essay on the 28th of October. On the 6th of November, Brad Keywell will be on the Council platform to talk about leadership and the entrepreneurial journey. And on November 13th, we'll expect David Rothkopf to talk about his new book called National Insecurity. I'll be back up to moderate the Q&A. Please join me in welcoming to the stage to introduce Martin Wolf, the Head of Financial Institutions for Commercial Markets at Zurich North America, Mr. Chris Taylor. Thank you.
Hello, and thanks for coming out in the rain yet one more time. On behalf of Zurich and the Chicago Council on Global Affairs, I'd like to thank you all for joining us for the second of our Fall Global Economic Series. Zurich is pleased to support this ongoing series of the Chicago Council. Together, our organizations recognize the need to lead discussion on the increased opportunities as well as the increased severity, frequency, and amplification of risk that runs through the world economy. Zurich is a leading global insurer in managing risk. For more than 100 years in North America and longer on the global stage, we've helped manage business risk and help them protect themselves in a rapidly changing, interconnected world. Addressing those issues requires a multi-taskholder response. Zurich and the Council play a role in highlighting these pressure points. Most recently this fall, we were pleased to host the Governor of the Reserve Bank of India, Dr. Raghu Rajan, who spoke on India and the global economy. Tonight, we're delighted to welcome back Martin Wolf of the Financial Times to discuss the lessons of the financial crisis. Last month, when I made an introduction and talked to a number of people in the audience, without exception, they talked also about your presence coming here, Mr. Wolf. In 2008, the true degree of interconnectedness of our financial system was both revealed and reinforced. Since then, governments, financial institutions, and other businesses and consumers have taken a variety of actions to both cope and adjust to the new economy. What remains is that all business, large and small, face risk regardless of size or scope of the organization. Insurance is essential to facilitating increased foreign direct investment and trade, especially through risk management in developing economies. As the largest recipient of foreign direct investment, the U.S. is the largest trader in the global economy. Without a system that incentivizes management of risk, both domestically and globally, trade will stagnate, dampening the impact of even the most progressive innovations in global growth. Despite years of recovery, is the deleveraging actually continuing, or is it shifting to public debt, as Mr. Wolf addresses in his recent column? This is last week. Are we trapped in a cycle of credit booms? October 7th in the Financial Times. In his article on the 9th of October, An Extraordinary State of Managed Depression, Mr. Wolf comments that high-income societies are in a truly extraordinary state. Defining aggressive monetary policies have been sufficient to halt accelerating deflation, but they've been insufficient to produce the needed expansion. So is the market recovery and limited bright spots in the U.S. Labor market real, or is it simply cheap money coming in, leading to another contagion? What have we learned, and what do we still need to learn to prevent another crisis? And what are the needed changes and sightlines across the global economy? As a leading commentator of global economics, we're very fortunate to have Martin Wolf with us today to help understand those issues and answer some of these questions. Let me briefly now introduce him. Martin Wolf is an associate editor and chief economist commentator at the Financial Times, which he joined in 1987. He's also a fellow at the World Economic Forum. Previously, Mr. Wolf was a member of the United Kingdom's Independent Commission on Banking from 2010 till September of 2011, a senior economist at the World Bank's Division of International Trade for 10 years, and a director of the studies at the Trade Policy Research Center in London. He's also advised governments and international organizations on trade and economic integration. In the year 2000, Mr. Wolf was made Commander of the British Empire for services to financial journalism, and he has been named one of foreign policy's top 100 global thinkers. He's regarded as one of the most influential economic journalists in the world. Mr. Wolf has authored several books, most recently, The Shifts and Shocks, What We've Learned, What We Still Have to Learn from the Financial Crisis, which received the following praise from the noted economist Joseph Stiglitz. Mr. Stiglitz said, an excerpt, "One of the things that distinguishes Wolf's analysis from so many others is that he sees a crisis as more than a financial crisis, an insight that is essential if we are to understand the failure to achieve a robust economy." Wolf may just have written the book to shake us out of our stupor. Ladies and gentlemen, please welcome Mr. Martin Wolf.
So it's an enormous pleasure to be back here. This is one of the most enjoyable audiences, though I know it's going to be very, very tiring. Just put this off. I should confess that I am in the middle of one of what must surely be one of the most sadistic activities the Americans have ever invented. It's called a book tour. And if I'd known what was involved, I would never have started. So it has been one seminar, interview, lecture after another, and this morning started at 5 o'clock my time, which I think is 4 o'clock your time, with writing a column. This was followed by doing a lecture, doing a 40-minute long radio interview, a rush to the airport, the wonderful excitement of landing in Chicago in the middle of a thunderstorm, and a rush to get here. If I remain more or less coherent, it will be truly a miracle. It is a great pleasure, however, to present the book, and I hope it will motivate some of you to buy it, because I can only just briefly cover some of the ideas in the book. And in return as a reward for buying the book, you will get the inestimable value of my signature. Now, fortunately, I presented some of these ideas last year, and though the audience is, I think, even more incredible in size, maybe some of you heard this. So I'm not going to go very deeply over the analysis of the past, though I will sort of try and cover it in about 10 minutes, perhaps a little bit more. But I want to focus more on the lessons and not so much on where the economy is going. I suspect there'll be a lot of questions on where the economy is going now, what stage we are in, though I will discuss that briefly, but more to focus on the structural questions, which are, have we fixed this? Can we plausibly expect further crises given the system we are continuing to run? And my answer to that question, in essence, is unfortunately, yes. We can expect further crises. We are continuing to operate a very fragile and unstable global economy and global financial system. What I have to say today will be divided into two parts. The first part will talk about what happened, how we got here. the shifts and the shocks. And the second part will talk about the solutions. And as I've already indicated, I'd like, if I manage to be sufficiently disciplined, to talk a bit more about the solutions than about the past. But you can't really talk about this, if I can start now with what happened, how we got here, my sense of this, which is roughly half the book. We can't really address this without taking on board, without really recognizing the scale of the policy failure that it was. With a few very distinguished exceptions, the disaster that we have lived through, and I think it is a correct description, was, despite some really, I think, heroic successes in warding off the worst, has been enormous. It's been enormous here, and it's been far worse in Europe, as I am going to show you. And unfortunately, in guarding themselves against the consequences of this crisis, emerging economies, and particularly China, made some of the same mistakes that we have made, and they're now living with the consequences of that. I think you should remember that really very confidently, policymakers believed in all the major central banks and finance ministries that up to 2007, we were living in something called the Great Moderation. We prided ourselves on the stability of our economies and the way in which the combination of liberalized financial markets and stable inflation had brought about an unparalleled period of stability. And of course, we know how that ended. It ended in probably, or at least arguably, the biggest financial crisis per se we have ever experienced, essentially a complete breakdown of the core financial system of the world, more fundamental in this respect, I would strongly argue, than what happened in the 30s. And this was followed, of course, by a very deep recession and a very weak recovery, which I will come to in a short moment. In my book, I argue that in trying to explain this event, the best way to do so is through the analysis of Hyman Minsky, who was a very brilliant economist, though largely ignored, because Hyman Minsky's view, which was very unfashionable at the time he put it forward during the 60s, 70s, 80s, and early 90s, he died in the middle of the 90s, was that, in essence, captured perfectly in one phrase, stability destabilizes. That is to say, in a stable economy, people will naturally and normally take actions, particularly in the financial sector and via leverage generated by the financial sector, which will destabilize the economy. And they will do so because it will seem profitable and rewarding in such a stable situation to take on more risk. And the easiest way by far, and really the only way, or the natural way for the financial sector to do so, is to increase leverage in the system. And that is precisely, and on a spectacular scale, what happened, probably unprecedented scale, what happened in the run-up to the crisis. But Minsky also argued that for such a runaway process to start, there needs to be a trigger event, a displacement event, I think is the name he used. And I have argued consistently, though I have, I think, now a deeper analysis than the one I presented here last time in the book, is that the key was indeed the emergence after the Asian crisis of a combination of a huge global savings glut, driving down global real interest rates roughly in half, a staggering shift over a short period of time in global real interest rates on long-term assets which were safe. I give evidence for this, and that triggered asset price booms, particularly in countries with elastic credit markets, and the most important such asset boom was, of course, housing, residential property, but also commercial property. This triggered as the value of the collateral rose, it allowed more borrowing, it allowed more spending, it allowed more construction. This occurred in a number of developed countries simultaneously. The US was not the only one. And in that environment, the financial sector was really off to the races. It increased the scale of its leverage internally dramatically, and it increased the leverage of the economy itself, particularly of the household sector and, of course, of the commercial real estate sector. Many people don't understand how far the current banking system is true here to a smaller degree because of the extraordinary role of government agencies in this country in providing mortgage finance, which is unique. You have a fully socialized mortgage industry, which to us who believe in the private sector find rather shocking. But nonetheless, banks basically do property-related leverage. That's the core of what they do, and it's even more true outside the US than it is here. And in this regard, the Eurozone process, I've described the global process, and there was one other element in this global process that's very, very important. Along with the global savings glut came an enormous export of capital from the emerging world to the developed world, a completely perverse phenomenon at a time of globalization when you would expect capital to go the other way. And most of that took the form of government capital, organized capital outflows in the forms of gigantic foreign currency reserve accumulations. And over the last 15 years, roughly speaking, global foreign currency reserves have increased by $12 trillion. There's also global sovereign wealth funds, many more trillions, and most of that has been invested in the developed world and has provided the background to these phenomena as I describe them. And a crucial element, as I've already described, this process was an unparalleled leverage of our economies. In the US case, the private sector's gross debt increased from about 150% of GDP to close to 350% of GDP in the 20 years before the crisis. And most of that increase occurred in the 10 years before the crisis in the household sector and in the financial sectors. There then was a major crisis, as I said, and of course since then there has been significant deleveraging, particularly in the US, particularly in the household sector, and even more in the financial sector. Much less deleveraging has unfortunately occurred in Europe. Now I want to come. You've already heard about my view on the idea that there was a contained depression, and I think that's a correct description of where we've been and where the Eurozone and Japan still are. In the following sense, since the crisis hit, interest rates offered by the official central banks have collapsed to near zero. All the four major central banks of the world are offering near zero interest rates, and they have been doing so with the exception of a very small twitch by the ECB, desperate to raise rates in 2011. They have been doing this since 2008. So we now have 6 years of free money, 6 years of global free money. To give you just one indication of how extraordinary this is, I like to give this example because it's probably one most of you won't be familiar with. It's the British case. The Bank of England has been around for more than 300 years. It's a very old institution. And it has been supplying money to banks, as it's the bank for banks, it has been the bank for banks since its foundation in the late 17th century. And over this long period, it's interesting to ask, what is the lowest rate of interest the Bank of England has ever offered prior to now in lending to other banks, to lending to banks? And the answer to that question, through 2 world wars and the Napoleonic Wars and all the other crises prior to this crisis, was 2%. It has never been below 2%. This time, it has been 0.5% for 6 years. And it is likely to remain at that rate for somewhat longer. I think that's some indication of the extent of the abnormality of the monetary policy environment triggered by the collapse of this staggering credit boom and asset price boom associated with it. And of course, that wasn't enough for the central banks. As you all know, there has in addition been an enormous expansion in their balance sheets. There's much discussion of what the effect has been, but that's been part of their policy tool designed to lower long-term rates, to signal their intention to support the economies. And that seems now to be ending in the US. With the balance sheet of the Fed up to a quarter of GDP from zero before the crisis. In the case of the Bank of England, ironically, it's exactly the same. It's also a quarter of GDP. The ECB was once, a little while ago, at 30%, has fallen, but it is now decided it's fallen to 20%. That's far too low, and Mr. Draghi is busily trying to find some way of increasing central bank lending. And of course, the Japanese are in a class of their own. They're hitting 60% and rising. So the age of balance sheet expansion has continued unchecked. The Fed is likely now, it seems, to stop its balance sheet expansion, but I don't think anybody really expects that it will shrink its balance sheet at all rapidly. It might never do so. That's in itself an interesting discussion. And how effective have these policies been in preventing this disaster? Well, I'll just focus on the US because I think I won't have time enough to go into the details of the Eurozone if I'm going to discuss policy reform. So I have two very simple measures of what has happened to the US economy since the crisis. If you take the trend growth, just a very simple trend of US growth from 1950 to 2007, you just fit a curve over that period. There's wobbles are down. There's a bit of a slowdown. So it was above it in the 60s, particularly. That was a buoyant period of growth. But over that period, the deviations from trend in either direction were not that large. The biggest positive deviation was 5%, and the biggest negative deviation was 5% from that trend. Since the crisis, the economy has never recaptured the trend growth, though it has been growing at about 2% since the worst of the crisis. And today, or to be precise, in the second quarter of 2014, the US economy was 18% below trend. 18%. Just to put this is the second point I wanted to make, is that I was very interested then to go back and look, and here I did it on GDP per head, to look at what the Great Depression did to the United States. And this actually surprised me. I didn't realize this, but if you take the 1870 to 1929 trend and run it forward, the US economy gets back on trend in 1960. So actually, the Great Depression turned out, of course, a catastrophe in every possible way. I'm not belittling it in any way. But in terms of the long-term growth of the US economy, it didn't affect it. But everything we see at the moment, this might change, there might be a sudden reversal, is this: the whole raft of studies of the impact of debt crises following huge credit booms do. Usually, the economies that are damaged after these crises, after the deleveraging process begins, never recover their previous growth rate. And if they recover their previous growth rate, they never recover the previous trend. And by the way, the US story is in many ways much more attractive than the European story. This is the only other bit of information I'll give you before I go to the latter part on lessons and what we can do about it. Today, roughly speaking, US GDP, or the second quarter, was 8% above in aggregate. So this is obviously aggregate GDP is 8% above that of the first quarter of 2008 before the crisis. So there has been, despite the recession, a real recovery. It is at least well above the starting point. The Eurozone economy in the second quarter of 2014 was 2.5% below the pre-crisis the pre-crisis peak, and real domestic demand in the Eurozone was 5% below the pre-crisis peak, showing no significant sign of recovery. I won't even go into the depths of the depressions that the more crisis-hit countries, which had no real capacity to respond to the crisis in the way you or the UK have been able to do, how badly hit they were. I might note that in the case of Greece, real domestic demand fell by 40%. 40%. So the Eurozone really hasn't recovered. It is still very clearly in, at best, a contained depression, with deflation increasingly a danger, and deflation means really the very severe risk that the real debt burden will progressively rise, and as people realize that, they're going to get more nervous about these economies. The extraordinary compressed spreads in the Eurozone with Spanish and Italian debt trading, public debt trading at lower yields than US debt is unlikely to last, and I think the crisis could return. So this is a gigantic disaster, it seems to me, with a very weak recovery despite staggeringly aggressive policy. Now, I'm not saying I actually am modestly optimistic about the future of the US economy, but it's still very likely that the scars of this will last forever. So the question then is, have we done enough to make it plausible that we're not going to have this sort of experience again? Have we addressed these problems? So let me just address this in the last 10, 15 minutes of my talk. Well, obviously, it goes without saying, policymakers have noticed that they were seriously wrong. You will be encouraged to know that there aren't that many people who take the view that nothing much happened. And they have developed what I call in my book, and I think this is my phrase, the new orthodoxy to replace the old orthodoxy. And it's obviously important to understand in what way the new orthodoxy in running our economies differs from the old orthodoxy. And it's quite interesting when you start listing it, and I'll come in the moment to the most obvious change. Inflation targeting is essentially unchanged, and it's changed at essentially the same rate. So that the basic target of monetary policy is not changed, though the instruments used, we now can see, are potentially much broader than anybody really imagined they were likely to be before the crisis. And indeed, as I've already indicated, the inflation target remains essentially the same. We have taken the decision, almost all countries concerned, that we really can't approach the management of these crises through large-scale debt restructuring. The idea is that we should grow more or less naturally out of debt. There's been quite a bit of bankruptcy in the US, but it was, to put it mildly, a somewhat chaotic and higgledy-piggledy affair. And in other countries, there hasn't even, on the whole, been that. And we basically ruled out, to a very significant degree, after the first year, any serious use of aggressive fiscal policy in response to this crisis. There was a huge debate about it, but the people who thought that fiscal policy was necessary part of the toolbox, particularly large-scale public investment, as part of the toolbox to deal with such a crisis. By the way, that's a view held both by Ken Rogoff, who was more or less centre-right, and people more on the left. So it wasn't among economists as controversial as it was among the people, but that was essentially ruled out everywhere. And what's even more important, we have basically the same financial system, but massively more regulated. And the way I put that is we've decided to keep essentially the same financial system. I'm going to talk about the dimensions of that, but we've lost confidence in it. That's a pretty bad combination, and the result is we have created, and I'll come to this in a second, a simply staggeringly complicated regulatory oversight machinery to make sure that, or to hope that we have made sure that the major financial institutions, any of the financial system as a whole, can't really twitch without without finding some regulator overlooking what it's doing. We have tighter regulation. We do hope for that next time there will be speedy resolution of banks in cases of difficulty, so we won't have to bail them out. That is the hope. Nobody knows whether that will really work in the case of bank holding companies. I suspect next time there won't be a bailout, it will be a difference, and I suspect that could be a very big mess given the system we have. The degree of concentration in the global financial system has substantially increased since the crisis. There's absolutely no doubt about that, because so many competitors in so many countries have gone under. You know that happened in the US, but it happened, by the way, even more strikingly in other countries like my own, where practically a whole raft of smaller, middle-sized banks disappeared, leaving us with an incredibly concentrated structure. About 25 major institutions dominate the global financial system. They're still essentially universal banks in the old way, and we still rely in assessing how much capital banks should have overwhelmingly on what I believe, and this is one of the points our Independent Commission on Banking made, are grotesquely unreliable and inherently grotesquely unreliable risk weighting of assets. And the most beautiful example of this, and I'm sure I've given to you before, but I still think it's wonderful, and since it's not from the US, it's not an invidious remark, it's from the UK. This is what happened to the major British banks, and I would remind you, because they're global banks, the balance sheets of the major British banks were pretty well as big as those of US banks. They were unbelievably large before the crisis. So in the 4 years, just 4 years before the crisis, the risk weightings on assets, just remember, the run-up to the crisis, the risk weighting on assets halved. That is to say, on the models that these banks used, the riskiness of their portfolios halved. Why did the riskiness of their portfolios halve? Well, they hadn't had a crisis recently, had they? And all the asset markets were buoyant, and the loan losses they were reporting were negligible, and they seemed to have a tremendous cushion in all the assets they held. And over the same period, since the riskiness of their assets went down, of course, that showed up as an enormous unwanted increase in capital. And the way they solved that was doubling their leverage. In 4 years, they doubled their leverage from 15 times to 35 times. And that's basically what happened to a lot of other institutions. And that, in a way, makes me sympathize with the regulators. In a very, very short period of time, these useless tools led people to make decisions without oversight, which were fantastically dangerous. Now, just to give you some example, an idea of the complexity of what we've done, I'm going to quote you from a part of a wonderful paper that was produced by Andy Haldane of the Bank of England and a colleague of his, and he's probably been the most interesting observer of what has gone on in the financial sector, in the official sector. He's done a whole slew of papers, and this particular paper was delivered at Jackson Hole to great acclaim. It was called The Dog and the Frisbee. I strongly recommend it. It's a wonderful paper on regulation and its absurdities. And it made him very, very, very unpopular among his peers. I won't go further on that because it might get him into trouble. I don't mind getting me into trouble, but I would not like to get him into trouble. So what he said is, as of July 2012, 2 years after the enactment of Dodd-Frank, a third of the required rules have been finalized. Those completed have added 8,843 pages to the rule book. At this rate, and I don't know the final figure, somebody may know this, I don't think we've got to the final figure, Dodd-Frank will deliver 30,000 pages of regulatory rulemaking. That's 1,000 times larger than its closest legislative cousin, Glass-Steagall. Dodd-Frank makes Glass-Steagall look like throat clearing. He then went on to point out that the Europeans, God bless them, do this much better than you, because it looks as though we're going to get to at least 60,000 pages of regulation. Now, I'm probably innocent about this, but I cannot believe that anybody imagines such a regulatory process can work in a sensible way, or that even anybody can know what the regulatory rule book actually contains in governing their activities. It seems a sort of demented way to proceed, but it is a reflection of this breakdown in confidence. But there is one really important new element in the policy proposals. And that's something that we're all going to get very used to. It's something called macro-prudential policy. And the idea here is, since the monetary policy regime will essentially do what it did before, we're going to have another set of instruments overseen by wise bureaucrats, which will regulate the entire riskiness of the financial system as a whole by manipulating things like minimum loan-to-value ratios, other practices of this kind in mortgage lending and other lending. It might be other areas. It might be auto loans. It might be student loans, whatever it might be. And there is a logic to macroprudential regulation, as you think of it as a way of ensuring that the financial sector is sound, whatever happens to the economy, and that the economy is also protected from the wilder vagaries of the financial sector. But I think we are putting far too much weight on macroprudential policy. I'm not saying it's impossible to improve things this way, but it's going to create some very, very big problems, in my view. First, the interventions by their nature are going to be very difficult to judge. Of course, when they really bite, they're going to be very politically unpopular because these bureaucrats will be interfering directly with the capacity of the people to borrow in times when things look good. More important still, in my view, and I discuss this at great length in my book in the context of the dilemmas the Fed faced in the early 2000s, it's going to conflict with monetary policy. So the more successful the regulators are in cutting the leverage being generated in the financial sector, which is the prime vehicle through which monetary policy works, that's how monetary policy works, the more aggressive monetary policy is going to have to be if they want to hit their inflation target. And that was essentially the dilemma the Fed faced in the early 2000s. If they had adopted a tight macroprudential policy to stop housing lending, interest rates would have probably had to go to zero then. And we don't know how those would have then worked. So this is, there's a big set of questions about how this will work. And I'm going to come at the end to what I think some of the alternatives are on the financial sector. But in addition to this set of questions, we have this fundamental problem of this incredibly weak recovery. Huge economic losses, as I've already discussed. So why have these things happened, and what might we be able to do about that, both now and for the future? Well, one reason these things happened, for sure, is that many of the pre-crisis trends were unsustainable. Once the leverage process stopped, they couldn't continue. So in some ways, the leverage masked, and this is very important, a deterioration in our economies that probably goes back 15 years or so. That's actually, I think, a very important, deep question to think about why that happened in the 90s, probably the 90s or the early 2000s. Second, the crisis clearly greatly damaged the economy in and of itself. It shattered confidence. It made business much more cautious. It made business, for example, persuaded business to hold huge cash balances instead of investing. Because the recovery is so weak, it makes it very rational to postpone investment. The weaker the economy, the more rational it is to exercise the option value of waiting and not to invest. So the crisis itself has huge legacy, particularly if you allow demand to be weak for a very long time, and you did, and in Europe we did it much more so than you did. And that, I think, is likely to be, has a cumulative downward effect on investment, you see very clearly in Europe. The crisis bequeathed a huge debt overhang, which I already mentioned, which we haven't really tackled. And of course, we made some very bad post-crisis decisions. And I would argue that's been particularly true in the Eurozone, where it's been very, very difficult to reach a concerted, sensible way of dealing with both the reform and adjustment side and the demand side simultaneously. They just haven't found a way of doing this. So what are we to do about these things in these problems now? So my argument is that we really need and continue to need a much stronger demand dynamic in countries which are still suffering from huge deflationary pressures. And I agree very strongly with the recent analysis of the International Monetary Fund, which follows the arguments of Larry Summers, that a crucial element of this at a time of exceptionally low real interest rates and exceptional legacy of needed public investment is a very large, long-term and large public investment program. I think it's something Europe needs, it's something the UK needs desperately, and I'm reasonably persuaded it would have been a very good thing for you, and it remains one. I know it's not going to happen, but it seems to me a very sensible thing to do. The IMF analysis, interestingly, actually concludes that if this is done in the right way, the increased growth can actually pay for the debt on its own. It will actually end up with less debt because real interest rates are so extraordinarily low. This is nearly the closest to free borrowing we'll ever get. And that's, of course, particularly strongly important in the Eurozone, where aggregate demand, as I've already described, has completely stagnant and stuck at 5% below pre-crisis, the pre-crisis level. And as I've argued in my column for tomorrow, that basically leaves all the members of the Eurozone struggling with each other, because they're basically all pursuing increasing competitiveness strategies, which means cutting wage costs, cutting labor costs. That's the essential strategy. They're all scrapping over this deficient demand rather than pursuing demand expansionary policies. But I also think, in addition to this, as I've already implied, we should have done, and we should still do, a much more aggressive policy towards restructuring debt. That's true for public debt in some of the Eurozone countries, obviously Greece, but in my view of others, but it's also true of private debt. We really have to try harder to get rid of the huge debt overhangs. Difficult to do, but as things are at the moment, the legacy of the crisis in many economies, I would include here, though possibly a bit less here, is just a huge burden for growth. I discussed that in last week's column. And I also think, as I've already indicated, that when you do fiscal policy in this way, you can coordinate it with monetary policy. If you're going to do QE, there are much more useful things to do with it, in my view, than buying assets which are near substitutes for cash, like government bonds. It could actually finance expenditures. I know this is wildly unsound, but it seems to me the sensible thing to do. And this wildly unsound policy of financing government directly in a depression through money, the creation of money, was actually proposed by that wildly unsound Chicago economist Milton Friedman. So if it's good enough for Milton, it's good enough for me. In the long run, now let me talk about the long run concerns. I think there is a fundamental global issue, which I've stressed here in the past, which is this ridiculous situation when the emerging economies are so frightened of opening themselves up to global capital flows that they would rather run their economies to export incredibly large quantities of capital to us, which we are demonstrably unable to use in a wise and sensible way. This is a ridiculous way to run the world economy. The last time we had globalization, there were huge problems at that time. I'm not suggesting we go back to that, but the last time we had globalization, the richest and slowest growing country at that time was the UK. It exported capital to the rapidly growing countries, particularly, of course, the US. And that's what we should be doing. And to make that possible, again, a radical proposal, we have to go back to the ideas of John Maynard Keynes in the Bretton Woods Conference, though he was focusing on current account, but this is now including capital account, which is to create an international institution that provides genuine insurance for countries that don't have reserve currencies to run current account deficits, to manage the possibility of sudden stops in capital flows, which they've all suffered. And for that, I think, personally, we need a much bigger IMF than we have now, instead of an IMF which in its aggregate resources is vastly smaller relative to the world economy than it was 60 or 70 years ago. I know that's not going to happen either, but the result of that is the emerging countries are going to go on pursuing these policies. In fact, I think after the taper shocks are all over. They're going to do it even more, and we're going to have an even bigger macroeconomic mess. And you in the US will pay the main price for it, because everybody's going to want to lend to you, and you won't find a way of using that money. I promise you that. And the other aspect of it, sort of very final, is what can we do about the financial system. I have a very long discussion of that, but I am personally persuaded, and I'm sure I've said this before, that there's a very strong case for just having much more capital in the financial sector, that the maximum leverage, and I think there's empirical evidence, properly worked out empirical evidence, for a sound banking sector should not be more than 10 to 1. That's already an incredible amount of leverage, which is about a third of the leverage we now see. True leverage. I'm not talking about risk weighting. I've already told you what I think about risk weighting. And I think that will encourage a great deal of shifting outside the banking system back into capital markets. I think that's fine so long, and this is the one task of macroprudential policy, so long as the banks themselves are kept separate from that, no more SIVs, special investment vehicles or conduits, none of that stuff. And so long as institutions that make bank-like promises, like money market mutual funds, I'm sorry, they do, are treated like banks, which is what they are. I also argue very strongly for reconsidering the immense amount of subsidization of leverage, of debt, which is in our tax codes. In all our tax codes, we encourage an enormous amount of leverage, which creates, as I've tried to argue, huge systemic problems. And one possibility, and that's the final possibility, I myself will put this forward, but it's also put forward in the book by Atif Mian and Amir Sufi, The House of Debt, good Chicago economist too, I think. It's a superb book, and it makes a wonderful argument for an idea that Robert Shiller, Nobel laureate, has also made, which is we should be shifting more broadly. And we can now, I think, more easily because of modern information technology, move away in many areas from pure debt contracts to equity sharing contracts. And that, for example, in my view, will be a much better way to finance housing, and I have some discussion of how you might do that. That could radically change the structure of the financial sector and make it much easier, as it were, to do in an automatic way what bankruptcy codes find very difficult to do when enormous amounts of institutions and individuals are affected by bankruptcy simultaneously. So let me just reach a conclusion to this discussion, which I know has been rather overarching. It's been a major disaster. I think we have to accept that. It was caused, in my view, by a complex interaction, which I've tried to spell out in the book. I can only touch on here, between macroeconomic forces and financial fragility. I do think the new orthodoxy is an improvement, but it's not a big enough improvement. We still have essentially the same financial system of before, and we hope that an immensely complicated regulatory architecture will prevent crisis. I suspect it will probably both prevent a very large amount of productive financial activity and still not stop the next crisis. But that's my bet. We'll see with that. We need to make the global macroeconomic economy much more balanced, as I've already indicated, and we have to make finance much less fragile. And I believe in that structurally by replacing debt in important and significant ways by equity-type contracts, risk-sharing contracts, rather than relying so much on debt. So that's, broadly speaking, my analysis, and these are my recommendations and analysis, and recommendations on the basis of that analysis, and I'm now delighted to take questions. Thank you very much.
Thank you very much. We'd now like to go out to the audience for questions. If you could please raise your arm and wait for the mic and make sure that your question is a question. That would be great. The gentleman right here, please. The mic's behind you.
Yes, thank you. My question has to do with Europe. Today I was analyzing 3 core countries like Germany, the Netherlands, and Austria, and comparing them with 3 peripheral countries, 4, Spain, Portugal, and Greece. And I found something interesting which I don't understand. In the period 2010-2014, in the indicators of growth, budget, deficit, and unemployment, the peripheral countries have been improving, whereas the core countries...
Could you speak into the mic, please, sir?
Oh, yeah, I meant that in this period, the core countries have been going worse, while the peripheral countries have been improving. For example, in growth, they are very similar, which is incredible how, for example, Greece, Portugal, and Spain have been increasing their GDP, while the Netherlands and Austria and Germany have been going down. I mean, it's something that I can't understand.
So what's the time period?
From 2010 to 2014, specifically in 2014. It had been the trend absolutely contrary to what I was expecting. And then I was asking why it is happening that the countries that are more powerful are going a little bit down, whereas the ones that were at the periphery, Spain, Greece, now they are doing better. Why is that possible?
Okay. Do you want me to answer these one at a time? We'll take a few.
Just overarching.
I will try to be... I don't find this at all surprising. There are two things going on here. First, the countries you list are beginning to recover after staggering recessions. And really staggering recessions. GDP has fallen in these countries from peak to trough by between the minimum of about 8 or 9%, and in the worst case by about 25%, which is Greece. And they're beginning to get some recovery simply because after a certain point, inventories have been driven down to the absolute minimum. So they begin to start rising again. The lending stops contracting and begins to rise a little. So you begin to start getting a bit of recovery. In addition, they had because of these massive recessions in a number of economies, the ones you list, really very substantial improvements in competitiveness, which occurred because nominal wages actually fell and productivity rose. And this is where my zero-sum story comes out. So the core countries lost competitiveness in the Eurozone, which is exactly what they were supposed to happen. But unfortunately, Eurozone GDP real demand didn't grow because there's no real demand engine in any of the core countries, next to none. So essentially, the success of these peripheral countries has, at least in part, come at the expense of the exports or inside the Eurozone of the core countries. That wouldn't matter. And they've also actually managed to export out of the Eurozone successfully, particularly Spain. That's the one great success. That wouldn't have mattered very much if global demand had been really strong. But global demand has not been really strong, and that's affecting Germany particularly because it's very dependent on external demand. And this then leads to the broader point, which is in the run-up to the crisis, a significant part, I won't go into the details, of the growth of the German export machine and the Dutch export machine, Austria to a lesser degree, was driven, of course, by these booms in the peripheral countries. And when the booms ended, the demand growth for these exports significantly shrank. Though all these countries export a great deal outside the Eurozone, their biggest markets are inside the Eurozone. It remains, I can't remember exact figures, but I think the most recent figures I looked at, about 60% of Germany's exports, I think, went to the Eurozone. So when these countries all went into crisis, that was damaging for them. And these markets are not coming back. What's coming back, so far at least, is more competitive supply. That doesn't help them. Now, in the very long run, 10 years or so, 5 or 10 years from now, you can expect some recovery of domestic demand, and that will filter through to the whole assemblage. But essentially, the way I put this is the process of adjustment and policy making in the Eurozone created a zero-sum game. And in the crisis period, the winners of the zero-sum game, interestingly, are the crisis-hit countries, because they are the ones that have gone through the most wrenching adjustments. And that actually creates a paradoxical situation. By the way, the country that has been most damaged, I think, by this zero-sum game is not, of course, Germany, which remains very competitive. It's France. And it's one of the reasons France is now in considerable difficulty and, in my view, is quite plausibly the next crisis country in this miserable chain.
Thank you. Next question. Yes, right there, please, on the end in the sixth row.
Thank you for being here today. I had the privilege of seeing you on France 24 a couple of weeks ago, and but I wanted you to speak about the efficacy of the announcement, or the potential efficacy of the announcement of that Draghi made on the I think it was the 29th or 30th of September, and what you think is going to be the outcome of this new stimulus announcement.
I think this is an absolutely fascinating question. Well, first of all, it's quite clear that Mario Draghi doesn't think it's going to be enough, because he said so. Okay, he's made quite clear that in both his Jackson Hole speech and subsequent speeches, and also a response to a question I asked in Washington, which has also been widely tweeted, whatever one does with these things, that he thinks that there needs to be more reform. We can discuss that. I agree with that. And more fiscal expansion, which, of course, there is no chance of whatsoever. But he said that. So he thinks what he's doing will not be enough. But he believes it will help. And I think it's quite clever. I mean, his idea is, in essence, he has a political problem, which is the Eurozone, for some strange reason, has this hysteria about buying public debt. So they want to buy bad debt instead of good debt. Now, there is a problem which I think is genuine. If you don't have a federal government and you don't have federal bonds, it's very difficult to know how to do QE. Technically, it's possible. You buy the bonds in proportion to the GDPs or the shares in the ECB, which are more or less the same thing. But the difficulty is, of course, you're going to take credit risk if you buy QE, because some of these bonds are issued by governments of doubtful long-term solvency. That's clearly true. But if you just buy German bonds, first of all, it wouldn't be acceptable, and they're already about, 0.8% now? I mean, what would be the good of driving them to 0.2? I mean, it's apart from giving a small capital gain to their holders, and so that's not, QE just isn't on. So, and the answer, so that drives him to go for going for something else. But there isn't anything else there, so he has to create a market. The good thing about it is he might create a working asset-backed securities market. And then he might not. We don't know. He wants to buy really high-quality assets, and the problem with asset-backed securities is there's always going to be a junk element in it. And how he's actually going to handle that really remains very obscure to me, and I suspect to many, many others. If this policy turns out to be a genuine part of credit easing, rather than QE. That is to say, it stimulates the creation of new securities markets, which then lead in time to the emergence of such markets, which allows banks, which are much too big in the Eurozone, they're 4 times as big relative to the economy as the American bank, to sell those assets into these securities markets, creating a new set of assets, which pension funds and insurance companies, I won't go into all the technical issues, there are many regulatory issues because it's very difficult for them, we can then buy. That could turn out to be a very useful medium to long-term assistance to the creation of more diversified capital markets. But in terms of actually stimulating the economy now, buying €1 trillion or so of this stuff, well, I know this sounds ridiculous, but it's small change. I mean, the thing you have to remember is the Eurozone economy is roughly the size as the US, so you need roughly the same size, a bit smaller, a bit bigger, depends on the currency, the exchange rate. And so I think it's going to turn out to be insufficient. But it's a very bold step, and it's staggering that he got agreement almost completely on the Council, with the obvious exception, to these policies. But it won't be enough. I think he knows it won't be enough. The chances are that over the next year or two, there will be another Eurozone crisis. I think I can see how it might happen. And if so, they're going to end up doing what everybody hates. They're going to end up with buying vast quantities of bonds or huge fiscal policy. This story is not over.
Great. Next question. Yeah, someone in the back there, please. Andy, right there, next to you.
Hello. Thank you very much for being here today.
It's a pleasure.
To what do you attribute the differences in the recoveries of the U.S. and that of Europe? Would you credit the monetary response, or is it more fundamental, the more entrepreneurial spirit, as some might say, here in the U.S. compared to that of Europe?
I think this is a fascinating question. To which it's difficult to give an unambiguous answer. It seems to me that the US dealt with its crisis problem much more quickly. And there's no doubt about it. The crisis phase of US policy making was over really, fascinatingly, with the stress tests. I mean, by then, the severe crisis pressure was over. And that was a relatively short period, roughly a year, less than a year, if I remember correctly. And thereafter, you move into the grinding process of recognizing losses, managing deleveraging. But the financial sector is basically functioning. I mean, it's not functioning great, but it's functioning. And because the US did that very quickly, it seems to me clear that confidence returned more quickly. Confidence throughout the confidence, in other words, that at least we weren't going to lurch into a disaster. That's very important. You cut off the tail risk. That's very important. The US did that relatively quickly, and I should stress, because this was done under 2 administrations and with a lot of agreement. And though I had a lot of technical differences with what they did, and I think they could have done much more in some ways, by and large, when the crisis really hit from the summer of 2000, well, I would say when the conservatorship of Fannie and Freddie, and then on through the stress tests, the US federal government showed why Alexander Hamilton created it. And, it's useful having a government. Now, compare this with Europe. This is my story. Imagine that in order to manage this crisis, you had to reach agreement among the 50 governors of your states. And they would have all said to the government, obviously this is a ludicrous parallel, but it just points out how difficult the Eurozone is to manage. And they would all have said, the governor of New York would say, would you please help me with these money sent to banks? And what would the governor of Texas have said? He would have said, it's all your fault, you're irresponsible New Yorkers, and if you can't bail out your banks, they might as well go bust. Well, that's how it starts until the conflagration starts, and then you risk, oops, you can't really let this happen, because if we allow all the money sent to banks in New York to go, that's going to affect Texas too. So then we have to do a deal, and you bring in the IMF, and you have these endless discussions. Well, basically, the Eurozone story just went on for years. And it was finally finished in 2012, that's crisis period, so this is 4 years later, when Mario Draghi basically committed the entire solvency of the ECB to an unknown and unspecified program of bond buying, which cut off the tail risk. So that took years. It was devastating. In the process, huge depressions emerged, and there was never a concerted agreement on macroeconomic policy other than monetary policy, except that fiscal policy had to be tightened everywhere, which is a zero-sum game. It, in my view, was completely foolish and has had exactly the consequences you can see. So the policies were wrong, and they took much too long. And then beyond that, yes, I think it's true, a number of European economies in different ways have huge structural weaknesses compared to the US. We're much less effective in the new technologies. There's nothing like Silicon Valley bringing forward a huge stream of new activities, new inventions, new innovations. The most powerful economies in the Eurozone are very good at producing exports for the world market, but then they're dependent on the world market, not what's bubbling up inside them. So the underlying dynamism is weak, much, much weaker. It's true of all the European economies to some degree, in my view, except possibly Northern Europe. It's rather small. And that means you don't get carried forward very effectively. I could go much further. I've got a long discussion in the book, but briefly, very briefly, that's how I would assess it.
Next question. Yeah, are there any... Oh, there's a woman right there, please, in the middle row.
I'd like to understand a bit better what you think the regulatory environment should be or could be to be more productive. And when you talked about risk-weighted assets, we actually have had a lot of cases where flat rates, flat capital requirements lead people to the riskiest side of the boat. If you make it flat, they just go risky. So what's your vision of what risk-weighted assets should be and what the regulatory environment should be, as opposed to the current one we're all assigned a personal regulator to work with us all day long? What's your thought about the best regulatory environment for banks?
Are you working in the bank by any means? Are you possibly working?
I'm a recovering banker.
You're a recovering. This is all very difficult. Now, when I'm told that this partly is a question of whether you think shareholders are even borderline rational. And this is a very interesting question. And there's a lot of, I don't have enough discussion of that in my book. I mean, if I were a shareholder and my bank had been forced to raise capital from me or by withholding dividends, and the bank said, well, now we have more of your money. We're going to run our institution. We have much more of your money than before. And so this is a big stake you've got in our institution. And when you think of the balance sheet of these banks, we are talking about a lot of stake. I did a little calculation of how much of the equity markets of the US and UK would end up being invested in banks if the equity ratio went to 10%. It's quite an impressive sum because the bank's balance sheets are so gigantic. I'll leave aside the point, which I expect, well, no, I'll come to that in a second. I expect the banks to get much smaller in this process. That's an important part of it. But if I were told as a shareholder, well, the answer we're going to find is that we're going to run this bank in an insanely much riskier way than before, or they wouldn't say insanely, a much riskier way than before, but don't worry about it, it'll be fine. That would make me very, very nervous as a shareholder. And I think I would be encouraged to say, I wouldn't want to put my money in this institution if that's what they're promising. And that is actually, I think, what would happen. That over the medium term, the banks would shrink. The banks would shrink. The balance sheets, and that's not particularly surprising. The balance sheets of banks today, relative to our economies, is less true in the US, really less true in the US, but in many countries have reached levels we've never seen before in history. So let me give you an example from the UK. The UK banking balance sheet is now 5 times GDP. Half of that, about 40%, is on domestic assets, 60% is global. I'll leave aside the global side. Whether the UK should be running this huge operation globally is a very interesting question. Terrifies the wits out of me, but something different. But even in the UK, the balance sheet is 3 or 4 times bigger relative to GDP than it was ever before. Has that improved our economic performance? No. Has it given us anything but a huge asset price boom in housing? No. So my view is we can do without that. Thank you very much. And we were not like this 15 years ago. We didn't have a tremendous problem. When Margaret Thatcher was Prime Minister, we were working perfectly well. Our banks were much smaller. We have to go back there. Now, the question, and that's what I think the capital ratios will do. They will, and that I think is what a lot of the regulation will do. Now, of course, the question is how the rest of the intermediation system will evolve. And I think, I don't discuss this, I think now in adequate length in the book, that we will have to go back to some form of capital market-based finance, hedge funds, mutual funds, all the rest of them, with the risks relatively transparent, separated out in different institutions where people understand more or less what they're buying, with much less of this stupendous amount of maturity transformation and risk transformation that was going on in the banking system in a completely opaque way. So the alternative, in my view, is not to try and regulate the existing structures, because the existing structures, in my view, are not workable institutions and have demonstrated this. If it takes a genius to manage an institution, it's not an institution that should exist. And if an institution, as Mervyn King basically said, and I think it remains the case, if an institution is too big to fail, it's too big to exist. It's not a market entity anymore. It's become part of the government, which is the argument I make. So I believe that over the next 10 or 15 years, we should envisage sets of changes, of which capital ratios are the most important, which will end up with a completely different or a radically different financial sector. Now, that will create risks and problems, I have no doubt, and we'll have to think about the way the new securities-based, capital markets-based financial system will work. But in the long run, it will be, in my view, and we did have something much more like this in the UK 100 years ago, that is the direction in which we should be going. And if we want really long-term risks, we want to offer 30-year mortgage, whatever like that, well, the people who invest on the other side have to have either matches in assets and liabilities, at least closer to matches, or the government does have to guarantee it. Now, in the US has been open about it. The government has guaranteed this in very substantial measure. But I actually think we should be thinking not about trying to regulate down to the ground essentially the same system as we had before the system. We should be thinking about how we will move to a new one, a different one, because that system, in my view, is dysfunctional. The transition is going to be very, very difficult. I understand that. But a part of the purpose of my book is to make people think, and I'm not the only person, but I hope in a relatively rigorous way, though I couldn't go into all the arguments, that where we are with our financial system, as I briefly described it, is really, really unsatisfactory.
A quick programming note before we go to our last question here in the second row with Phil Levy. Mervyn King is confirmed for the spring for the Global Economy series, so that save the date
will
be
agree
out,
with what I said.
Phil Levy,
very, very strongly. And so will some other central bankers, by the way. Not all, but some others. It's not just wild outsiders like me.
Thank you. I wanted to come back to fiscal policy to boost demand. You spoke in favor of this both prospectively and retrospectively. My question is about the timing and how this works. I think you could make the case that one reason more was not done in the U.S. was we know from the forecasts released at the time, they anticipated a shorter downturn.
Yep.
That spending that was going to take place in 2011, 2012, 2013 was going to be too late because we would be over things by then.
Yep. Yep.
How does one deal with the fact that these are policies that work with great lags and we do a fairly poor job of forecasting?
Yes, I think that's right. I mean, my answer to you would be, and I mean, I have to say this, the people who were in the administration then were people who I have to regard, though journalists shouldn't have friends. You know, my rule in life is not to have friends, as it were. And I explain to my friends that I'm not really their friend, and though I will keep all their confidences, and I always do, I will attack them, and I have quite frequently. I've attacked Larry, I've attacked Tim, people I met in many ways I like. But I think they got it completely wrong, and it was obvious. I said it at the time. It was obvious. And the reason they got it completely wrong is they hadn't drawn the lessons of international experience. The people who got it right were the people who really studied what happened in Japan. See? So I wrote a column about it in February 2009, or maybe January, I can't remember exactly. This was going to be a balance sheet recession. We had a huge debt overhangs. There was no way it was going to be like previous US recessions because it was different. It was fundamentally different. So they used the standard econometric models. They were very smart people. But the standard econometric models were, like all these things, obviously built up based on data which weren't relevant because this was a different sample, because we had created, as I've already pointed out, this immense debt overhang in the process, and this immensely fragile financial system, which was not going to function as the financial system had done in previous recoveries. So it seemed to me clear that, Ken Rogoff and Carmen Reinhardt had shown this in their wonderful book, that it takes 7 years, was their line. 7 lean years and 7 fat years and 7 lean years. It pretty well was 7 fat years and 7 lean years. 2000 to 2007, and then and we're now in 2014. It's 7 years, so we should be getting a good recovery. But it was going to be 7 years. It was ridiculous to imagine that this will be over in a year or two. my own sense of this, that is that part of the reason they made these ridiculous forecasts, which would have called for much more stimulus, is that the political side of the administration had already decided they couldn't get agreement to it. So there was no point in asking for what they couldn't get. So they decided to adjust the analysis to what they could get, and then the analysis, or at least they were encouraged to accept an analysis which was in fact quite implausible. But all that, of course, in a way, though I think it's analytically correct, supports your point. When you are in a completely different situation from the before, the natural instinct of most people who haven't thought about this very, very hard, including really well-informed economists, is to say, well, it won't really be different. In this respect, this time was different, because of the nature of the crisis. So you're right. The big arguments against fiscal policy, and I accept this argument completely. I've never been in favor of this. And I'm not an all-purpose, all-round, at all circumstances Keynesian. I am not. I just think that every 70 years or so, we get into a Keynesian situation. Every 70 years or so. Not the other. And intelligence, in my view, consists of realizing when you're in a different sort of situation, like one in which interest rates are zero for 6 years. That's a different sort of situation. I have no doubt John Maynard Keynes would have recognized it was different, and I have no doubt, actually, Milton Friedman would have been recommending helicopter money. I do really think that's what he would have been recommending, because he was flexible. He had the intellectual self-confidence to do so. So I think that's what should have happened. But in practice, even in times when it's really necessary, you get there too late. That is absolutely true. But I thought there was another argument, which I made in a column 2 or 3 years later, which got quite wide notice, and I got attacked by one of my, a friend of mine who was also once upon a time a Treasury Secretary, and he said how wildly irresponsible I was. And basically my argument was, well, forget about the timing of it. Just look at real interest rates. We have been living in a zero interest rate, long-term interest rate world for 7 years. And there really isn't much sign this is going to end. There's no real reason why it should end. Look at the world. You can borrow this money now for 10 or 20 years. You can borrow it now at that rate. You see? It's locked in. Once you've done it, you've locked it in. You can then build your stuff. Okay, it's possible that some of the timing won't be perfect. It might possibly be that it'll hit a huge construction boom, though it seems rather unlikely. But you've got that shielding that comes from actually pre-financing it at an incredibly cheap rate, which the government has been able to do in the US case and the UK case for 7 years. Could have done it at any time. There's never been a better time to borrow long, ever. Right? So the governments, in my view, should have done lots of borrowing long, put it in the bank, okay, so they lose a little bit on this, and then spend it on buying things that people want. And in this environment, okay, it might not be perfect fiscal policy, but at least at the end of this mess, you will end up with some nice, bright, shiny new roads, airports. Have you been to your airports recently? This is not suitable for the world's greatest economic power. I mean, if I may say so, with the greatest possible respect, JFK is worse than Heathrow, and that is saying something. And we have the worst infrastructure of any major European country. So why not? What's the problem? So even if it's not optimal fiscal policy, I think future generations will turn around and say, okay, you saved us some deficits in order to save us the burden of deficits and debt. You've saved us the burden of debt, even though, as I've argued, it was unbelievably cheap, so it wasn't much of a burden. Do you really believe that the US economy is going to grow less than 1% real? It must be possible to get a growth rate higher than these real rates of interest. But your children will turn around and say, but what else did you leave us? Collapsing roads, which we'll still have to fix. So not doing this is just a false economy. So that will be my answer to you. And the UK is the same. Now, in Europe, many countries have much better infrastructure, and Japan has overdone it. I'm not suggesting doing the Japanese thing. But there is a via media. There is such a thing as a golden mean. And I think the US and UK are on the wrong side of this golden mean. So that was my answer. Of course, it's failed utterly, and it's not what you're going to do, and I think you will regret it.
Ladies and gentlemen, unfortunately, that's all we have time for. Please join me in thanking Martin Wolf.